Welcome. Today, we're diving into a classic finance book that's been a staple on the investing bookshelf for decades, A Random Walk Down Wall Street by Burton G. Malkiel. Whether you're a seasoned investor or just curious about the stock market, this book offers valuable insights. So, let's get into it. A Random Walk Down Wall Street was first published in 1973, and it's been updated several times since then. Burton Malkiel, an economist and professor, provides a comprehensive guide to various investment strategies and the overall behavior of financial markets. The core idea of the book is based on the random walk theory, which suggests that stock prices move randomly and cannot be predicted consistently. Here are the key takeaways from the book. 1. The efficient market hypothesis. The author argues that financial markets are highly efficient, meaning that all available information is already reflected in stock prices. This implies that it's nearly impossible to consistently outperform the market through stock picking or market timing. 2. The random walk theory. This theory is central to the book. It posits that stock price movements are like a random walk. Essentially, future price movements are unpredictable and independent of past movements. According to Malkiel, trying to forecast market trends is largely futile. 3. Investment strategies. The author discusses several investment strategies. Active management, or trying to beat the market through frequent buying and selling of stocks. The author is skeptical of this approach, arguing that it often underperforms due to high fees and poor timing. Passive management, or investing in low-cost index funds that track the overall market. This strategy tends to provide better long-term returns and lower risk. The author suggests that investing in funds is a better strategy for the average investor. 4. The role of diversification. Diversification is a big concept in the book. The author emphasizes the importance of spreading investments across different asset classes to reduce risk. By holding a mix of stocks, bonds, and other investments, you can better weather market fluctuations. The idea is that if one asset drops, an investor will be covered by other different types of assets remaining stable or increasing in value at the same time. 5. Behavioral finance. The book also touches on how psychological factors can influence investor decisions. Investors are not always rational. Here are some key concepts in behavioral finance. 1. Overconfidence bias. Many investors believe they have superior knowledge or skills compared to others. This overconfidence can lead to excessive trading and risk-taking. For example, someone might believe they can time the market perfectly or pick the next big stock, even though studies show that most people can't consistently do this. 2. Anchoring. This refers to the tendency to rely too heavily on the first piece of information encountered when making decisions. For example, if an investor first hears about a stock at $50, they might fixate on this price and have difficulty adjusting their expectations, even if the stock's fundamentals change. 3. Herd behavior. Investors often follow the crowd, making decisions based on what others are doing rather than their own analysis. This can lead to market bubbles, where prices are driven up by collective optimism, or market crashes, driven by collective panic. The dot-com bubble and the 2008 financial crisis are examples where herd behavior played a significant role. 4. Loss aversion. This concept, introduced by psychologists Daniel Kahneman and Amos Tversky, suggests that people experience losses more intensely than gains of the same size. For instance, losing $100 feels worse than the pleasure of gaining $100. This aversion can cause investors to hold on to losing investments for too long, hoping to break even rather than cutting their losses. 5. Mental accounting. Investors often separate their money into different accounts based on its intended use, which can lead to irrational behavior. For example, someone might treat a bonus as play money and take more risks with it, while treating their salary as serious money, leading to inconsistent financial decisions. 6. Confirmation bias. Investors may seek out information that confirms their pre-existing beliefs and ignore information that contradicts them. This can lead to skewed decision-making and reinforces existing biases, making it harder to adapt to new or contrary information. In A Random Walk Down Wall Street, the author acknowledges these behavioral finance concepts to provide a more complete picture of market dynamics. He argues that while these psychological factors can lead to market anomalies, they don't necessarily invalidate the random walk theory. Instead, they highlight the complexity of human behavior and its impact on financial markets. Understanding behavioral finance is crucial for both individual investors and professionals. By recognizing these psychological biases, investors can make more informed decisions and avoid common pitfalls. Don't forget to like, comment, and subscribe for more content on investing. To wrap up, A Random Walk Down Wall Street is a must-read for anyone interested in understanding the complexities of investing and the stock market. It promotes a disciplined, long-term investment approach and challenges the notion that individual investors can consistently beat the market. If you enjoyed this summary, don't forget to give it a thumbs up and subscribe to the channel for more book summaries and financial tips. Have you read A Random Walk Down Wall Street? What did you think? Let us know in the comments below. Thanks for watching, and see you in the next video.